Beyond the headlines, the secret gold-silver price drivers. For those of you new to gold and silver or new to the channel, this video is for you. Have you ever wondered why gold and silver prices seem to move on their own, often defying conventional wisdom? You're about to discover the hidden forces and secret drivers that truly dictate the value of your precious metals, far beyond what the daily news tells you. This isn't about headlines, it's about what's really happening behind the scenes. The allure of precious metals, beyond the obvious. A timeless fascination, gold and silver are far more than shiny objects. They are woven into the very fabric of human civilization. From the pharaohs of Egypt to the conquistadors of Spain, from the coins of Rome to the jewelry of modern India, these metals have served as symbols of wealth, trust, and permanence. Unlike fiat currencies, which rise and fall with governments, gold and silver exist outside of politics. A Roman coin still carries value 2,000 years later. Try saying the same about a paper dollar from 1913. More than money, gold is chemically unique. It doesn't rust, tarnish, or corrode. That permanence makes it the perfect store of wealth. Silver, meanwhile, combines monetary tradition with unparalleled industrial utility. It's the most conductive metal on Earth, essential for modern technology. Investors feel this on a gut level. In times of calm, gold and silver may be forgotten, but in times of uncertainty, they become indispensable lifeboats. The allure is primal. When trust in institutions falters, people reach for what history has proven cannot be debased. Unmasking the geopolitical chessboard power shifts that don't make headlines, gold and silver act as barometers of trust in the global system. But while financial media fixates on jobs numbers and CPI releases, the real moves often come from geopolitical shifts. Regional conflicts fuel demand. When Russia annexed Crimea in 2014, gold surged 15% in 3 months. When sanctions hit Iran, silver rallied as investors sought hedges against instability. Emerging market instability matters. When the Turkish lira collapsed in 2018, gold priced in lira exploded, even while dollar gold was flat. Similar stories play out across Argentina, Nigeria, and Venezuela. For locals, metals are survival, not speculation. Central banks quietly move markets. China has reported steady monthly gold purchases since 2022. Russia doubled its reserves after sanctions cut it off from Western currencies. These flows dwarf the daily noise of Wall Street. Case study: Russia and the sanctions shock. When the West froze Russia's $300+ billion in reserves in 2022, it sent shockwaves through the global system. For the first time, sovereign reserves held in dollars and euros were treated as political weapons. The lesson for many countries was simple: gold is the only reserve immune to sanctions. That one move has driven a structural increase in global gold demand as central banks seek insurance outside the Western banking system. It wasn't a headline, it was a tectonic shift. The invisible hand of fiat currency and debt, fiat's slow decay. Every modern currency is fiat, backed not by gold, but by government promises. Over time, promises weaken. Since the Federal Reserve was created in 1913, the dollar has lost over 97% of its purchasing power. Gold and silver don't pay interest, but they don't decay either. They remain outside the system, preserving value while fiat melts away. Debt as destiny. The U.S. debt clock ticks past $35 trillion with no signs of slowing. Deficits have become structural, not cyclical. Every dollar borrowed today is a dollar diluted tomorrow. History shows debt crises end in two ways: default or devaluation. Neither is good for fiat, but both are good for gold. Quantitative easing, liquidity without limits QE, was supposed to be an emergency measure in 2008. Today, it's a permanent feature. Each round of QE pumps liquidity into asset markets, inflating stocks, bonds, and real estate. But it also fuels distrust in fiat stability, pushing investors toward hard assets. Case study: the 1970s stagflation era. When Nixon closed the gold window in 1971, the dollar became a pure fiat currency. Inflation soared, deficits ballooned, and by 1980, gold had risen 20-fold. The lesson was clear: when fiat credibility collapses, metals explode. Technological disruption and industrial demand. Silver, the indispensable technology metal. Unlike gold, silver is consumed. Once used in electronics or solar panels, it's rarely recovered. That makes supply tight even before new demand trends are considered. Green energy is silver hungry. Each solar panel uses 15-20 grams of silver. EVs require up to twice as much silver as traditional cars. With governments mandating clean energy, demand is structurally higher. Tech revolutions amplify consumption. 5G networks, AI chips, and quantum computing all require silver's conductivity. Gold is increasingly used in high-reliability electronics and medical devices. Supply cannot keep pace. Global silver mine output peaked in 2016. Grades are falling. Political risk in top producers like Mexico and Peru is rising, and recycling can't fill the gap. Case study: the solar supercycle. In 2022, global solar installations hit record highs. Silver demand from photovoltaics alone reached over 140 million ounces, more than 10% of total annual supply. That demand is expected to double by 2030. Industrial users don't care about silver's price. They need it to function. That means price spikes won't kill demand the way they might in other commodities. Mining supply constraints. Another secret driver lies on the supply side: falling ore grades. Average silver grades have dropped by 55% since 2005. Companies must process more rock to get the same ounces. ESG pressures. Investors demand green mining, increasing costs and slowing projects. Geopolitical risk. Peru and Mexico together produce over 40% of global silver. Political instability or tax hikes in either can shock supply. CapEx drought. After a decade of weak prices, miners underinvested in new projects. That means fewer future ounces coming online. The result: even as demand surges, supply growth is constrained. Common misconceptions about price moves. Mainstream narratives often mislead investors. Fed hikes kill gold. In the 1970s, gold soared, despite rising rates, because real rates stayed negative. It's not about hikes, it's about real yield. Silver is just a monetary metal. No, industrial demand consumes more than half of annual silver output. Monetary and industrial dynamics together make silver unique. Daily headlines explain trends. No, headlines explain noise. Structural forces explain trends. Historical echoes that matter. Hunt Brothers, 1980. Their attempt to corner silver revealed how fragile supply-demand balance is. A squeeze pushed silver to $50, nearly $200 in today's money. 2008 financial crisis. Gold soared from $700 to $1,900 in 3 years as QE undermined fiat trust. COVID-19, 2020. Silver collapsed to $12 in the panic, then tripled to $30 as stimulus flooded the system. History shows metals thrive when trust falters, and trust falters more often than headlines admit. Preparing for tomorrow, Actionable Insights track what really matters. Central bank flows. Watch the World Gold Council for monthly updates. Real interest rates. Inflation minus yields is the true driver. Industrial demand. Monitor solar, EV, and semiconductor data. Supply constraints. Follow mining reports from Mexico, Peru, and China. Practical Investor Playbook. Physical metals. Coins and bars are the foundation. Focus on low-premium bullion, like American Eagles or Canadian Maples. ETFs. GLD and SLV offer exposure, but beware counterparty risk. PSLV, Sprott, offers allocated metal, mining equities, leverage, but with risk. Producers and royalty companies like Franco-Nevada or Wheaton Precious Metals can magnify gains. Diversification. A balanced allocation, 5-20% of portfolio, protects against systemic shocks. A final call to action. Don't get lost in the noise of headlines. The secret drivers of gold and silver aren't daily CPI numbers or Fed speeches. They're the structural forces shaping our world: debt, fiat decay, geopolitical mistrust, technological revolutions, and mining constraints. The investors who thrive are those who see beyond the headlines, who read the forces behind the noise. Gold and silver aren't just assets, they're mirrors of trust. And in a world where trust is in short supply, metals may prove to be the most valuable assets of all.